Channel, I'm Doris and I'm here to share with you about my stock account and today's market update. Today my stock account has made a loss of $4,656 US. Today US stocks closed higher and with Treasury yields falling and all three major indexes were up for the week. Even teenagers are asking about zero DTE options. In my account today, including the post-market price, I've made a total loss of 6.19%. So right now the net asset of my account is $73,257.89. Today, SQQQ made a loss of 6.13% and decreased to 36.73. And the RV made a loss of 4.76% to $45.97. In the market today, market showed an overall gain with a recovery from yesterday, and Dow Jones Industrial Average rose for 1.17%, Nasdaq Composite rose for 1.97%, and S&P 500 rose for 1.61%. Today, most of the industries performed well, with the tech industries rose for overall more than 2%, and the auto manufacturers industry rose the most by 3.07%. Treasury yields fall back was the 10-year Treasury yield falling below 4%. Several Fed officials spoke. Investors are reflecting on the Fed's future policy path to raising interest rates. Treasury yields continued lower Friday, with the benchmark 10-year yield falling below 4%. The yield on the 2-year note fell to 4.855%, rising Thursday to its highest level since 2007. All three major U.S. stocks indexes rose this week, with the S&P 500 up 1.9% in the week, ending 3 straight weeks of declines. The Nasdaq rose 2.58% and the Dow rose 1.75%. Markets are still evaluating the Fed's future policy path. On Thursday, Atlanta Fed President Raphael Bostic said he thought the Fed could keep the rate hike at 25 basis points, rather than 50 basis points favored by some other officials. Bostic also said on the Friday that the Fed may pause in raising rates after midsummer this year. But the Fed Governor, Mr. Christopher Waller, took a tougher tone in his comments on the same day, saying end interest rates could be needed if the inflation data did not cool. Waller noted that the January non-farm payroll report showed 517,000 jobs in the economy, and the latest data such as the consumer prices and personal consumption spending report showed high inflationary pressures. Waller said, if these data reports continue to be short, the policy target range for this year will have to improve further to ensure that we do not lose momentum ahead of the January data. Analysts believe the road ahead is tough for the Fed, whatever the message they send to the public. Bleakley, Chief Investment Officer Peter Bookford, said, no matter how slow the Fed is, no matter how much they convey what they want to do, they can always skip the obstacle of reversing unconventional easing. He said, the market and the economy have been treated with low interest rates and quantitative easing for so long and have been addicted. There will never be a good time to exit. Rubini, known as Dr. Dune, bearished the U.S. economy again this week. In a media interview on Thursday, Rubini warned that a perfect storm of inflation, stagflation, recession, and a potential debt crisis was about to hit the United States. Rubini has been issuing similar warnings for months. He believes that the U.S. is about to face a stagflation debt crisis that comes the stagflation of the 1970s and the 2008 financial crisis. With the U.S. CPI remaining high at 6.4% in January, Rubini estimates the Fed would need to raise its benchmark interest rates well above 6% to meet its 2% inflation target. Fed officials speaking on Friday included Fed Governor Michelle Bowman and Richmond Fed President Thomas Borgen. Bowman did not comment on the outlook of the U.S. economy or monetary policy. He said the key issue for the Fed was how clearly distinguish between the asset purchases and monetary policy action. On the economic data from Friday, the Association for Supply Management Services Sector acting index came in at 55.1 in February, roughly unchanged from the January 50.2 reading. The average market forecast is 54.3. A reading above 50 suggests an expansion in the services. In the past 33 months, the index has been above 50, only to fall below that watershed in December 2022. Financial markets have been unbreakable rule for many years. Whenever a new force emerges, such as quantitative easing, leveraged ETFs, high-frequency trading, etc., a new product emerges on Wall Street and becomes a paradise for adventurers. Another rule is for a financial product called zero-day maturity options, which have a maturity date of less than 24 hours. From private stock investors on Reddit to professional Wall Street investors who criticize its risk, talking every day about how risky the financial instruments that can be quickly triggered on. JP Morgan strategist Marco Kolanovic warned of volatility of Doomsday 2.0 if zero DTE options explode. Outside Wall Street, there is a Twitter account that is nothing but just every day predicting whether the growing number of such options will take the overall stock market. One fund manager said he was worried about the situation when teenagers also started asking about zero DTE. Because of zero DTE options are heavily traded, short due, and are undisclosed as traders, it is difficult to understand how crazy such options are. While some argue that such derivatives can reduce market volatility, while some are themselves the source of extreme volatility. When you have big swings, you always hear someone say, "You have to be careful, you're making a big problem," said Malcolm Polly, Stewart Capital Advisor, LLC President and Chief Investment Officer. I don't think they know it all, because we've never really seen that before. Zero DTE options were found to be a cheap hype tool by retail investors when the internet read stocks exploded in 2021. Last year, after CBOE Global Financial Inc. and other institutions covered the maturity date and of the S&P 500 index options took every working day, the zero DTE option based on the stock index trading got another boost. Was the Fed's most aggressive monetary policy in decades, the U.S. stock market has become commonplace, and the zero DTE options have become an institutional darling. By the third quarter of 2022, zero DTE contracts accounted for more than 40% of the total volume of S&P 500 options, almost double the volume of 6 months ago, according to the data compiled by Goldman Sachs Group. And this is a graph that shows how much the zero DTE options out of the total S&P 500 volume collected by Goldman Sachs. We can see that the dark blue bar, which rose dramatically over the recent months, and recently has just passed over 40%. JP Morgan believes that explosive growth could be driven mainly by high-frequency traders, market makers, and short-term traders. Zero DTE options and quantitative trading are a natural pair for quantitative institutions that can calculate the trading cycle in a thousandth of a second. The benefits of zero DTE are obvious, such as balancing risk exposure and optimizing fast in and out trading strategists. According to Kolanovic, JP Morgan's top derivatives trading strategist, this success actually sets the stage. In his view, risk is concentrated on market makers, who, as counterparties, must buy and sell shares to remain market neutral. One fear is that the self-reinforcing downward spiral will trigger turmoil across the market, creating a risk of events like the 2018 volatility explosion. But Bank of America strategists quickly reversed the theory, arguing that the market today is much more balanced than it was 5 years ago, when it was prone to a sharp reversal because everyone was betting on the lower volatility. In this week's latest report, Bank of America strategists such as Rudy Prasa and Nitin Saxena observed that 0DTE option volumes accelerated last year, with short-term trading following increasing, and 0DTE gaining net buying. Under summed, market makers need to follow current trends, buying stocks when they rise and selling stocks when they fall. However, intraday momentum trading has been steady in recent months, which Bank of America attributed to increased option selling. In other words, there is no one-sided market that could cause a similar February 2012 slump. The huge market capacity of 0DTE may have absorbed the initial demand impulse, but there are also more and more sellers, Bank of America strategist wrote. Spot Gamma founder Brent Kachuba said, has found that the explosive growth of 0DTE options is actually a positive market force. The most influential part of 0DTE right now seems to be that 0DTE calls are used by on the tips after a short shop. To some extent, it suppresses the volatility. This graph shows the signed delta versus the move from this low. When there is a higher 0DTE positive delta flow, which means more of are flowing off low, and the longer dated options aren't generating positive deltas during the big market bounces. Regardless, day traders for the lucrative new game. PGIM Quantitative Solutions Chief Investment Officer George Patterson has experienced the enthusiasm of retail investors for such products, and some of his teenage friends have been recently asking him questions about 0DTE options. While such products can be used as a hedge in the short term, he considers it too risky for the non-professional investors. 0DTE option trading is another hit for retail investors, who think it is like a lottery. Patterson said, some analysts say 0DTE is undermining the effectiveness of the VIX, widely used on Wall Street. While the 0DTE contract reflects increased anxiety in the market, it is not within the VIX radar, and the VIX calculation are based on the S&P 500 index options of 23 to 37 days. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.